for long entry. And that's what this is. This is, well, I'm going to go for like 3 hours if I keep doing this. But price behavior is something that's very difficult to understand, but you will get better at it with time. Whenever there's been a move down or a move up, the first significant move off the lows or off the highs is typically not people positioning for the next reversal. It's typically closing of positions. There's an old saying that bear markets are bear market bottoms, so the bull market starts, right? The bear market ends when the bears take profit. The bull market ends when the bulls take profit. People think that bear markets end when the bulls step in and they start buying. No. And bull markets absolutely do not end whenever the shorts start shorting. Bull markets end when the big players take profit. Right? That means they're realizing their gains. And the downtrend will end after the shorts have closed and then it goes and attacks again. So you want to just view it in two phases. Right? Let me try and explain this. If you've ever wondered, why does price come down and come down and come down and then look like it's reversing and then sweep? Because this part, this reversal, seeming reversal, that is shorts closing. That's people taking profit on their shorts or who shorted the lows getting squeezed. Short covering. That's why you'll often hear about a short squeeze rally, which is more strong, or just this kind of grinding up. That is not bullish buying. It's shorts closing. Then, people who are going long there, mistaking short covering for long strength, will get long, they put their stop at the lows, their stop gets taken out, and then, at that point, typically you'll see a break here, and that's where you'll see bulls starting to build positions. And that's how you get your reversal. So, just the takeaway from this should be, the reason to exit one position is not a reason to enter the other, because if you do that, you're assuming V reversals all the time. If you always assume that the reason why you should exit your short is to get into a long, you're assuming the market's going to go like that. It's never going to pull back, right? It's just going to V. It's going to V, and everything's a fucking V reversal. I mean, you can't just have that. You can't just have V reversals all the time. Consolidation. And that is it. GM. Now, questions. I'll fly through this because, as always, I've gone fucking way too long. And Hugo, GM. On a day trading basis, do you measure overextensions mostly at market structure? I have a few ideas I could test based on internal ignition market structure break. Yeah, I've already covered that. You should combine market structure with another concept, yeah. Liquidity sweeps, gaps, order blocks, moving averages, whatever you want. Volume profile. Asher, question about reading market structure instead of a range. Do trends within the accumulation distribution phase follow the same principle of trends and exits in the range to try to avoid reading too much into it? Already said this. Don't read too much into it, yeah. Fake breakouts, 25, 75, and so on. So, head and shoulders, BOS, double bottom, FTR technically, internal structure. Yeah, all the internal structure is still valid. It's just that your targets might not be the same, right? So, for example, this head and shoulders, a target for that head and shoulders would be probably to take out those highs. Because it's still within an internal structure, this head and shoulders just leads to a lower high. It's still valid. The head and shoulders is still most inverse head and shoulders. The inverse head and shoulders is still most likely to produce a move up, and it does. This BOS, classic trend signal, classic trend signal, right? This break of structure, what does a break of structure do? It leads to continuation. Does this lead to continuation? Yes. Just not to new all-time highs that people might expect, but it does do exactly what it's supposed to do. Price goes higher. Strong impulse candle breakout goes higher for like a week. The FTR, failure to return. Bottom, fails to go to a new low. What does it do? It reverses. Breaks structure, up, takes out the local highs, and there it goes. So yes, all of that is completely valid. You just have to view it in context of where it's going to go next. Stefan, GM, I always see you mention the bands are holding the price. When we look at the price action, see there's exactly an order block or fair value gap at that level. So what is actually holding the price? The bands, FVG, or both? It's never just one thing. And that's what the whole point of confluence is. So if you're looking at the bands holding and you notice that it's holding at an order block, and that's something you test as rules, that's going to provide generally stronger signals than just the bands, right? So that's why applying the market structure along with a confluence is your higher probability setups. Moneymaker, why does price have to retest an area before continuing to reverse back? What's actually happening in the market at that moment? It just does. It's like, I get this question a lot. I used to think this as well, right? Something that, especially if you're quite an analytical thinker and you're, somebody who really likes to fully understand things before internalizing them. At a certain point, you'll realize this, and I did too. A certain point, you'll realize there are just things that the market does, and you don't need to have an explanation for it. Liquidity is a perfect example. If you just look at the charts and you trade for long enough, you'll know the price tends to reverse at specific key levels. And over time, you get better at identifying them, but price will reverse at important highs and lows when it hits liquidity. Price will set a bottom and it will sweep it and go higher. And you can say, why is it? Is it trapping longs? Is it manipulation? Is it a stop hunt? Is it fucking magic price delivery algorithm? All that bullshit. It's none of it. It's just, that's what price does. The best example I have for retest, and this is, in my opinion, this is 100% the only reason, if you actually just boil it down, the market exists to facilitate trade. That's why markets exist. If you view this from like auction market theory, markets exist so a buyer and a seller can come together and do business, right? So if price has been at a level and does not spend long there, that's what an untested area looks like. It bounces or it dips or it rallies very quickly off a specific level. Price did go there. That means buyers and sellers did business there. That means the market wanted to be there. And when it moves away very fast, that leaves behind what's known as an inefficiency or an imbalance. And the tendency is that price will come back to retest that area, either a higher low, a sweep, or whatever. So it can test, is the demand there genuine? Was this move away correct? And also, if you're viewing it from the perspective of orders filling, big players who are trying to fill orders will typically have to take multiple stabs at it, right? If you've got a large order that gets filled, first time it comes down, it might fill part of it, then it moves away. You're not going to move your bids up. You're going to leave your bids there. Once it exhausts its momentum, it's going to come back and you get more fills. So that's as much as needs to be explained about it. I strongly encourage everybody to just accept that retests happen. You don't need to know why. You just need to look at the charts for long enough to realize what's more likely. Is it more likely the price will reverse and never come back? Or is it more likely the price will come back? I can tell you with absolute certainty, it is more likely the price will come back for a retest of any level if it has left it behind, with a V, any kind of V reversal. How long it takes to come back and retest, that's unknown, right? You can't know exactly how it's going to look or when it's going to do it, or if it's going to be a lower high or a double top or a sweep. Nobody knows. But absolutely, the V reversal is your reason to exit longs, for example. Then the retest is your reason to enter shorts, like I said. The reason to exit one is not the reason to enter the other. Stelios, GM, you talked about not wanting to enter a position after closing another. What about getting stopped out in a long and you get triggered a short right after it's valid? Well, if your system says so and your system is plus EV, then trade it. Trade your system. My point is when you're building systems, right, when you're actually thinking about what rules should I put in here, then if you get a reason to exit, right, this is something that everybody can do right away. If you trade both ways, long and short, take your best system and take the exit rule. So when your system tells you to exit your long, observe what happens after. Observe, my best system says I should exit my long when the bands go red. Then just say, okay, if I just look through the last 100 trades, either backtested or live, is that actually the best place to enter a short? Because it's my best system and it tells me to exit long. So it must be a good system, must be a good rule. Is that the best time, the exact best time to enter a short? And observe the market. How often does that become the absolute top, just where you would have entered? Or how many times would it come up and actually give you a better fill? Or sweep you out or whatever? And yet, why wouldn't this market structure away from moving higher as made the higher low because times it bias low profit entry? Is it because it was false breakout moved to higher highs? Why wouldn't this market structure break before moving higher hasn't made the higher low yet? Which one? You've just sent me my own screenshot. So, be the low prob for entry. Is it because it was a false breakout and moved to higher highs? I don't know which one you're talking about. I'm not sure. You haven't marked anything on this. So if you're talking about this general uptrending structure, so there was no market structure break here, right? This impulse candle, there's the low, never broke, right? And then everything thereafter, remember the visual of the right side of the V? At no point along here do you have any kind of right side of the V reversal. The first time you get that is here, when it exhausts, drops back, breaks there. And again, it's not like you have to exit on that exact candle. It's once price trades into this area, you have the highest probability reversal, which does not mean it's the absolute top, which is why you don't enter shorts necessarily. But yeah, so because it's not marked, I can't say, I don't know exactly which part you were looking at. That is it. GM. All right, thanks for joining, everyone. That is the weekend workshop number 13, Advanced Market Structure. There will absolutely be more market structure ones, for sure. There's probably 2 more full lessons of that I haven't covered. So a lot of this, by the way, a lot of the questions you might have will probably be answered in one of the next market structure weekend workshops, because I definitely need to do more of them. And that's it. GM, thanks for joining. This will be recorded and posted, and it will be live for the rest of the weekend. Make sure you take your notes, because it will disappear on Monday. Thanks for joining, everyone. GM.
With Professor Michael G. Trading game strong, schooling all the wannabes. No recordings, no replays, gotta be there live. Boot camp students, let's hustle and thrive. Dot charts and candlesticks, college ball.